Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
So this week, we're going to have a look at the latest inflation prints across the globe and in the US and what they mean for monetary policy. We'll also have a look at increasing signs that Chinese growth is re-accelerating. And finally, we'll have a look at the performance of commodities that are relevant for the SA economy. We're going to start off with global inflation. At this point, 42 of the 50 largest economies have reported inflation for last month. Inflation across the globe ticked up slightly. It's now sitting at 2.5%. It's at the sort of level that's not particularly worrying, but it is interesting that inflation has surprised on the upside for more than 50% of countries that have reported so far. And that's not often the case. If we go back over time, there's really only a couple of occasions where inflation persistently surprised on the upside. Now, it's not persistent yet. It is really only for 1 month, but it is something that we need to keep an eye on. Globally, inflation has ticked up, but also surprised on the upside. We're going to focus on the US. US inflation also ticked up. It was at 2.7%, up from 2.4% the month before, and above the consensus forecast of 2.6%. And it provided the first signs that tariff increases in the US are likely to see higher inflation. We can see that in more detail if we look at month-on-month inflation. Month-on-month inflation was 0.3% in the US. That's the highest reading that we've seen in 6 months. For simplicity's sake, let's assume for the moment that it is just 0.3% going forward. If month-on-month inflation is 0.3% going forward, then what happens is that year-on-year inflation shortly gets to around 3%, and it stays at around 3% all the way through to around November. One would need to see month-on-month inflation much lower. You would need to see it about 0.1% to see year-on-year inflation down to 2% by November. And what this sort of scenario analysis allows us to do is to say that we should expect inflation to be high for some time, and it's quite unlikely that inflation is going to be at that 2% target in the US anytime soon. Now, that's our view. It's also the view of the consensus forecast. If we look at the consensus contributors to Bloomberg, the current consensus forecast is that inflation will average just a bit above 3% in Q3 and then get to just a bit below 3.5% by Q4 before starting to drift down. So quite clearly the case, it's widely expected now that inflation is going to get to the sort of level that's uncomfortable for the Fed. Now, that's headline inflation. The Fed targets a different inflation series, core PCE inflation. But we can look at core inflation in the US as well, and core inflation is sitting at 2.9%, which also suggests that even the series that the Fed targets is likely to be elevated for the foreseeable future. There's one bit of good news in the inflation data, and that is that shelter inflation continues to decline, now sitting at 3.8%. The simplest framework to look at US inflation at this point is that we're going to have tariff increases, which will push up components of the inflation basket, and those will be in part offset by declining shelter inflation. But still, the net result is that inflation is likely to increase in the short term, and we'll have to monitor these changes very closely to try and gauge what it's likely to do in, say, a year's time. In the interim, inflation expectations in the US have diverged from Europe, and Germany in particular. At the moment, the 10-year inflation expectation implicit in the bond market in the US is 2.5%. So the bond market is saying that inflation is going to be above the Fed's target on average through the next decade. Whereas if in Germany, the inflation expectation in the bond market is currently below 2% at 1.75%. And in Japan, even though it's been going up, it's still at just 1.5%. So clear divergence in inflation expectations between the US and Europe. Now, what does that mean for interest rates? Well, at the moment, the market is pricing in the first rate cut to occur in October. Now, that is a little curious, given that the current consensus forecast is that at that point in time, inflation is going to be above 3%. Now, as it is, a month or so ago, the market was expecting the first rate cut to occur in September. So the market's already pushed out the point at which the Fed is likely to cut, but 4 cuts are still priced in over the coming year. And that does seem unlikely given the inflation dynamic we discussed at the top. So it does seem that there's some risk that the market is going to have to revisit its interest rate expectations, and at this point it seems to be a little too optimistic. Switching to China, and unlike the US, there's increasing signs that Chinese growth is re-accelerating at this point. The key leading indicator for us is a series called Total Social Finance. This is a series that includes money raised through IPOs and debt issuance. The 3-month average of that series is up 40% year on year. And that tells us that we should be penciling in a re-acceleration in Chinese economic activity over the coming 9 months. There are other signs too that the Chinese economy is re-accelerating. If you look at money supply growth has been re-accelerating, it's now up over 8%. If you look at export growth is up 6% year on year. Might not be a massive number by itself, but it probably is much greater than had been widely expected when the Liberation Day tariffs had been announced. So a wide set of indicators suggesting that China is re-accelerating. And in addition, as it is, we saw last week that the Chinese economy is currently growing above 5%. And as we see further of these indicators, we would expect that the Chinese economy is going to provide support for commodities, and some of which have done very well of late. Just a final point to note on China, while real GDP growth is up 5% year on year, nominal growth is up just around about 4%, suggesting that there have been widespread price declines in the Chinese economy. So growth that might be very helpful for Chinese consumers, but top lines have only been growing on average by around about 4% in China. So it's not necessarily good for the Chinese stock market, but it is good for the Chinese consumer, and it is likely to be good for commodities. And that leads us to South Africa. If we look at the relevant basket of commodities for South Africa, so we weight commodities by the amount that we export, that basket has recently done very well. It's ramped quite materially. The 6-month average is now up nearly 9% year on year. And it's not often the case that we see a move of that sort of scale. And when we have seen moves of that scale, it's clearly been very helpful for miners' earnings, but in addition, very helpful for tax revenue for the state. And at this point, look, what we're looking at the moment suggests that not only do we not need to see further increases in taxes come February next year, but there might actually be some scope for relief. So this is something we're going to have to keep a very close eye on. It is still very early days with regards to the fiscal year for the government, so we'll provide updates over the coming few months or so. But at this point, it does seem like we're going to see some relief for SA consumers directly due to higher commodity prices. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.